Investors Chronicle.
Hello and welcome to the Companies and Markets Show. It's Thursday, the 11th of May, as we record, mere moments after the Bank of England raised interest rates for the 12th straight meeting. To mark the occasion, we are back talking about banks today. Virgin Money reported interim figures last week, and there's plenty to discuss there in terms of both a possible end to the hiking cycle and the nagging question of whether problems in the US banking system will find an echo over here, as well as the figures themselves, of course. Speaking of the US, we are also going to be discussing this week's cover feature, which asks whether those companies upping sticks and moving their listings across the Atlantic really know what they're in for. And to conclude, we discuss a pretty positive update from what is for many a British institution. I am, of course, speaking about Wetherspoons. On the occasion of all this UK and US chat, we are joined today by Julian Hofmann, who's actually somewhere in Germany. Hi, Julian.
Guten Tag, Dan. How are you?
I'm very well, thank you. Wetherspoons expert Mark Robinson is also with us over the line. Hello, Mark.
Hi, Dan. I'm not broadcasting from Wetherspoons, I hasten to add.
In the studio with me is Jemma Slingo. Hi, Jemma.
Hi, Dan.
So let's start with Virgin Money. Mark, you covered the interims for us. Looked to me like a bit of a mixed bag on things like net interest margin, impairments, costs, and so on.
Yeah, I covered it very gingerly, going through point by point, really. The return on tangible equity, that sort of shrunk since their year end as well. But there's some fairly straightforward reasons for that. When you look at the cost pre-provisions, they ticked up by about 2%, and loan losses increased during the period as well. Over the long run, the company's targeting double-digit statutory returns on that basis, and the research that I've read about it suggests that analysts are in two minds whether that's achievable in the short term, at least, because I think that they're aiming to do that by full year 2024. But it might be a little bit difficult given the macro challenges as well, particularly as there's the first signs, for instance, that their loan book can be under a little bit more pressure as we go forward.
You say the loan book there as well. There were, a little increase in sort of bad loan provisions. Costs as well, as I said, in general, were a bit higher than expected, I think, which is quite interesting, really, because they seem to pin some of that on the delayed rollout of their kind of digitalization, if you will, of their mortgage service.
Yeah, that was one of the reasons they gave as well. And plus there was some one-off costs. They hired 300 temporary contractors because they're trying to improve their user experience, which is well, that a poor user experience isn't just confined to the challenger banks. The major high street banks are having difficulties in this area, but that obviously that sort of increased the short-term cost base. That was in response to the level of their inbound calls and complaints sort of rising too.
Yeah, that was quite intriguing, really. They said, as you mentioned, they hired 300 contractors effectively on the back of the mini budget to deal with the spike in calls, complaints, and probably people concerned about mortgages and maybe more interested in savings. That was a short-term, one-off expense, but it's quite interesting that they had to put that much manpower behind it, and to the extent that it did delay the rollout of some of these new services, the restructuring, because they were focused on that customer service side. I hadn't really seen anything like that from the other, obviously the big four banks, by as the name there suggests, are, you would assume perhaps better staffed. It seems quite unusual, really.
Virgin Money is the smallest of what we would call the high street banks by some distance, so it's there's a certain amount of elasticity in how they can run the business, and it doesn't surprise me at all that they had to hire in so many more staff to do that. It reflects this kind of size, and you can see that the size of the bank is also indicative in other metrics, in its other key metrics, and and what it's going to return on capital, and it is in some ways a leaner operation, which is why its underlying business is doing almost slightly better than the competitors, because it's on they don't have hundreds and hundreds of branches to worry about, and that cost base is quite manageable, as it were.
Yeah, just on that, one of the positives was as I said, the net interest margin, which was a little bit above expectations, and the full year guidance was upgraded slightly as well. On one level, it is in slight contrast to the big banks who have been starting to say, understandably, given perhaps the rate cycle is at an end now, that their own net interest income maybe wouldn't be as high this year as people suspected. I don't know, Mark, Julian, if you think if this is a timing issue. I mean, obviously Virgin's full year runs to 30th September rather than the calendar year. Is it that benefit, as you say, being a challenger bank, they're already offering a bit more on deposits, they don't have that kind of pressure coming through?
I think it's significant that they saw an overall increase in their deposit base over the period as well. Now, I contrasted with what's happening in the United States, and obviously there's very specific reasons why depositors have taken flight there. But within a couple of days of the write-up on this, I noticed that the big UK high street banks had been losing deposit rates. And I think what it is, and this is just based on my own experience, but I wouldn't mind betting that a lot of our listeners have had the same experience, is that so many of my friends are now looking around for better interest rates for their money that they've parked in Lloyd's and Barclays. And I think that suggests that, part of the basis is that the challenger banks are in a position to actually draw in custom just through enhancing interest rates.
Yeah, I mean, it's benefiting others, isn't it? Like Paragon and One Bank, they have a natural inclination towards attracting deposits because their broader capital base is much smaller in absolute terms than you would find at, say, NatWest or Lloyd's. And that gives them an incentive then to people. That gives an incentive then to people to move their short-term savings to somewhere like Virgin Money. The question is whether that situation will continue for much longer. There is a bit of research out now saying that every 10 basis points of movement we get in deposit rates. So if you're having to offer higher interest rates, obviously that's cutting down the margin you're earning on your broader interest rate between your debt and your income, and that knocks about $1 billion off profits for the entire sector. So I mean, obviously everybody shares equally in that loss every time the rates on deposit go up by 10 basis points. But everybody, the key fact though is that everyone, Virgin Money and the others are still writing new mortgages at 10% return on tangible equity. So whether that's going to make a lot of difference in the future is open to question. But definitely the movement in deposits is quite material when it comes to ultimate profitability.
Yeah, this obviously, as we've said, this pressure across the Atlantic in particular, where, a lot of banks, people have woken up to the fact via the banking crisis or mini crisis that they really aren't getting much return on their money. Over here, it's not quite as pronounced, and certainly you wouldn't think a threat to the banks structurally. But as you say, Mark, there is the sign of that starting to happen as well, people looking for those higher rates. Interestingly, I did see some figures from Morgan Stanley comparing instant access deposit rates and 1 year fixed rates. And Virgin are actually quite low on the instant access front, but on that 1 year fix, they are near the top of the pile. So for people looking to, lock in those high rates, that's clearly an attraction. I think also on the analyst call, Virgin's management were suggesting, it's the big back books of the big four as well, which could be an issue. There's a much larger potential for some of that to move away as opposed to their relatively somewhat smaller book of existing business.
I think the incentive increases as well the longer the inflationary pressures drag on, and they don't sign. There's no signs of that abating at the moment.
The valuation mark of Virgin, I mean, low single-digit forward PE, it's pretty cheap. Equally, there are obvious headwinds to banks, not simply in terms of this crisis, but in terms of, economic slowdown, higher impairments that we see come through, that kind of thing.
Well, certainly. I mean, they increased impairments over the period as well, but I mean that was only to be expected. They looked at credit bureau data and the modelling and assumptions based on that, and increased. But I mean, we could have predicted that prior to the results, really. Now, what will happen as we go forward and how quickly we may well have reached the peak interest rates of this cycle as well. So that would be the prime consideration. But, we shouldn't ignore those inflationary effects too. I think looking at the consensus figures are saying that the market anticipates the bank adding another £20 million to income, but costs will increase on the same level too. So it's not exactly screaming value on that basis at the moment. Actually, the market is also pricing in a potentially larger buyback once the stress tests have been undertaken. But, as you mentioned, there are sort of considerable macro issues to take on board when you're looking at them.
Yeah, may still be one for the too difficult pile for now. Let's turn to our cover feature now this week, which is on the idea in the stock market context of the American dream. Jemma, you wrote this piece. Very much the backdrop is, of course, problems, if you want to call it that, of UK companies, certain UK companies looking to list or move their primary listing to the US. And this piece is perhaps, we're trying to not say they're all crazy to do so, but just to talk about, the grass isn't necessarily always greener in all cases. And, sometimes it's not as simple as saying, well, if we move to the US, then our business is suddenly a wonderful business when it wasn't before. Can you talk a bit first about kind of that kind of context of the piece?
So there was a recent headline in the Times, I think, talking about this exodus of companies from London. So I just wanted to press pause for a minute, really, and consider first, how big a trend actually is it? And second, is America really all it's cracked up to be? And I think over the course of my research and as I was writing the piece, I became more and more convinced that actually the situation's more nuanced than it's often portrayed to be.
Yeah, and some of these nuances, I suppose the obvious one on one level is the cost itself of relocating. We can talk about all the factors behind it as we have done, but when it comes down to the actual logistics, these costs, certainly if you're a smaller company, can be quite significant.
Yeah, so that cropped up a lot when I was talking to people for the piece. So basically, the cost of actually listing is high, particularly, as you say, if you're a small company used to relatively low fees, and then the cost of existing on a US exchange is also high. So you've got quarterly reporting, for example, and various compliance rules which you don't have to think about in London. And I think when you're considering in broad brush terms the appeal of America, those sort of nitty-gritty elements can often be lost, but can actually be a bit of a drain on your profits.
There has been a bit of talk in the last couple of weeks, again, it's AGM season, about executive pay and whether, the part of the reason for management teams deciding to up sticks is knowing that they can, A, get paid a lot more, and B, have a lot less pushback on those kind of pay packets, which is, to an extent, certainly ostensibly, pay is higher, but there are other factors to consider, again, from a company level in the US, such as, the prospect of litigation, things like that. I mean, this may sound like I'm making a worst case scenario here, but these are things that businesses have to consider as well.
Yeah, I think just generally the US is far more litigious than the UK. So the risk of legal action if you're a company is a lot higher. But that point on executive pay, it's tricky, isn't it? Because it's hard to know how to react to that as an investor, because you have got this balance of, well, you want to retain the talent, but at the same time, there are these shareholder revolts against these massive pay packages. And instinctively you feel like, come on, surely shareholders need sort of a piece of the action as well. So it's tricky. And obviously the UK is known for its high corporate governance standards, and that's one of the key attractions. So you feel a bit wary of tampering too much with that side of things if you were, for example, the London Stock Exchange.
Absolutely. I'm going to preface my next question by saying, the piece is, we do try and give a balanced look at the situation. We're not just, bashing the US, but nonetheless, we should also look at the experience of companies that have gone over there, certainly companies that have listed over there. And, once again, that's not in recent years, this is. And once again, if you're a young, new company, it hasn't all been a bed of roses simply by listing in the US compared with the UK.
Yeah, it's a tricky one speaking from the UK, because obviously we've had our fair share of disasters and you don't want to be throwing sort of stones in your glass house. But I think it's fair to say that the US has had some very similar problems. And it's particularly noticeable with the UK companies that struck US SPAC deals sort of before and after the pandemic. These deals have really not done well. So according to one set of data, companies that struck those deals since 2019 have lost 87% of their value. And there are some really high profile examples. So if you think about Kazoo and Babylon, you get a sense of what's been going on. So I think there's definitely reason to to question whether the US is this magical solution for companies looking to boost their valuations and thinking that London is really the source of their problems.
Speaking of London, let's take a more positive stance and look at some of the other things the piece touches on in terms of areas where the UK market still has some strengths, because there are the companies, not just the established old companies. There are areas where the UK market is still standing out, or is perceived to still be standing out.
Yeah, there are a couple of areas that cropped up. So one was neobanking. So one analyst I was speaking to said a lot of these companies were interested in US SPAC deals when that craze was ongoing, but US investors weren't really interested because the European regulation was complicated and they weren't particularly familiar with it. So some of those companies are now starting to return home, apparently.
These are kind of challenger banks kind of things.
Yeah, exactly.
Yeah.
And another area is emerging markets businesses. So the London Stock Exchange is actually the second largest African exchange in the world behind Johannesburg. And obviously that means companies have a big peer group and there's lots of investor knowledge. So those two factors often help support valuations. And I think there's a feeling that in the US there isn't that experience and knowledge. So, for example, companies in Africa might still be tempted to move to London.
That leads on to my favourite angle on this whole issue, which I mentioned before on the podcast, which is simply Greenwich Mean Time and the fact that the UK you can run a business from the UK, a global business, quite easily, purely by virtue of time. So, that maybe has something to do with some of the emerging market prospects, or the existence of those companies, continued existence in the UK as well.
Yeah, very possible.
I'm never gonna give up this bold investment theory.
A brief history of time there from Dan.
Exactly. Of course, in the UK, some of this has been perhaps overhyped. There's still a relatively small number of companies, maybe famous last words, who have shifted their listings to the US. Perhaps a more pressing concern, certainly for shareholders if they feel they're being undervalued. Given there are very few IPOs right now in the US or the UK, and given the amount of takeover activity we're seeing in the UK, that is perhaps a more pressing argument for shareholders.
I think that's true, yeah, because over the course of writing the piece, there was this flurry of private equity deals being announced. So obviously you had Decra, there was SureServe, Hive Group, Medica, a whole string of them suddenly came out in fairly quick succession. And I think in a way, maybe that's more of the pressing issue that rather than companies looking across the Atlantic, because obviously if companies go private, that means you've got far less variety in London. There's less companies to choose from really as a retail investor, and that will presumably increase the concentration of risk if certain sectors start getting reduced by private equity deals. So that's definitely something to watch for, I think.
Yeah, I mean, as you say, when companies disappear, it's a different case. When they move to the US, UK investors can still keep hold of them. They've got to fill in a bit of paperwork and sort out the withholding taxes, things like that, but it is still feasible, and as opposed to companies disappearing altogether. As I say, this is the cover story this week, so do look out for that on the shelves and have a look, because it is still a live debate, and I think it brings some important context to that discussion. We're going to finish today, though, back in the UK with Wetherspoons. Trading update out a couple of days ago. Mark, once again, you were looking at this relatively positive, all things said, albeit for a business that has been under quite considerable pressure in recent years.
Yes, certainly the tone was far more positive than we've seen over the last, since the outbreak of COVID-19. That obviously had a major impact on trading, not just because of the lockdowns itself, but afterwards too. Generally, the sentiment seemed quite a bit more positive, even though the chairman, Tim Martin, he's still highly critical of government policy or sort of industry regulation in the wake of the pandemic as well. But I guess the main point is that sales are now ahead of the pre-pandemic levels. There was a 12.2% increase in third quarter sales as well, with a particularly good Easter, although the company did note that the coronation was something of a damp squib, really. I guess that reflects people's street parties. There was the further action on debt as well, which would be welcomed by shareholders. And the company continues to rationalize its estate as well. It seems the emphasis on getting out of smaller, older venues into larger establishments, which presumably are the more profitable end of the business as well.
Yeah.
There's 30 outlets that are still on the market as well. So presumably we'll see a further contraction in net debt as the year progresses. And overall the market responded very positively to the figures, driving the shares up by 5%, and adding to the momentum that we've seen since the end of last year.
That recent trading, notwithstanding the coronation aspect, which, as you say, is perhaps more of a street party or in the house kind of thing, that did stand out, the positivity of those figures. I think, as has been highlighted in various people picked up this comment, and they said that the first Saturday bank holiday in May was their busiest ever Saturday. And really, it suggests, the cost of living pressures haven't really come through or haven't really affected pubs so much, or perhaps, are playing into Wetherspoons' hands insofar as it does have more of a value proposition.
Yeah, well, definitely. I mean, it's difficult to quantify on that basis, but anyone who's been into their local of late will have noticed that the steep increase in beer prices, whereas the core sort of value of Wetherspoons is it does have that value proposition, and that probably becomes all the more important as the cost of living crisis intensifies. Household budgets, discretionary income, both shrinking, and their key demographic for Wetherspoons as well are people that actually, well, it sounds quite obvious really, but pub goers. I mean, it's not as if they're going in there in terms of going out to lunch necessarily or evening. It's a sort of wet trade, and a fairly consistent one at that. So I think, I think if anything, the cost of living crisis will potentially show up the value of that business model.
Mm. Well, I think it's Peel Hunt who noted that Wetherspoons, they have put through their own price increases recently, 7.5%, I think, but like-for-like sales were ahead of that, so they have managed to increase volume as well as price, which is relatively rare nowadays, and does play into that argument. The estate, though, you mentioned some of the pubs closing, and there is this concern with Wetherspoons about some of their city centre venues, given what is still, compared with pre-pandemic, relatively low footfall or lower footfall in city centres, certainly from the office trade. I mean, how much of that is a long-term concern or a medium-term concern still about where they're positioned physically, geographically?
Yeah, well, I mean, they're obviously not the only business that are vulnerable on that basis as well. I haven't looked right through the estate to see the percentage of their outlets which are either in a city or just on the periphery. I think, like anyone else, it's a consideration for the company. Although the impression that I got, as I mentioned, it was they seem to just be selling off sort of their smaller, more marginal assets at the moment. Now, who's to say maybe their city centre pubs fall within that category? It seems to me that they're prioritising their larger venues, and presumably the volume trade is where it's at the moment.
Yeah, absolutely. A final thought on the valuation. Still looking pretty full in your opinion. I know we have in the publication some people who certainly argue that. What's your take?
Well, yeah, I mean, I think the forward PE ratios just under 33 at the moment, which seems very high for a pub group as well. But the consensus forecast has that falling to just over 17% by 2025. So it's probably heading in the right direction there. The most worrying thing, I think, in terms of the valuation is the group's free cash flow yield is forecast to fall and fall quite significantly over that same time frame. So I think you're better off on the sidelines at the moment.
Yeah. Julian, I'm going to quickly throw to you. Do you have anything to add on Wetherspoons?
I'm not really. I mean, it's a very clear business, isn't it, these days? And I mean, obviously no statement from the company would be complete without an extended Tim Martin moan about something. But I mean, it does show its resilience, I think, in the terms of that they position themselves very well for people who just want to go out for a pint or something, or maybe a microwaved burger, and it will continue in that vein. And if the model is working, there's no point changing it that much, other than perhaps getting rid of the lower value bits of their estate. So basically the banks that have become Wetherspoons are going to become something else, basically.
Indeed. Well, on that note, that does bring us to the end of today's show. We have unfortunately run out of time, but thank you to all of our guests this week. Thank you to Mark and to Julian and to Jemma, and thank you to you for listening. We'll see you next time on another Companies and Markets show.